In my last recording, I talked about the yield curve's excellent record as a leading economic indicator of a recession, and more importantly, why I believe it works. So I encourage you to watch that if you haven't already. My point about why the yield curve is an excellent leading economic indicator is critical. In my last video, I used a lot more words to say it, but basically, the banking system doesn't work as designed when the yield curve is inverted. As our banking system doesn't work right for longer and longer, it increases the likelihood that it will make our economy sick. We have a credit-based monetary system, and unfortunately, the banking system is the foundation for the creation of credit. Don't get mad at me, I didn't create the system. Today, I would like to touch on a point that I first heard from legendary macro hedge fund manager Stan Druckenmiller. And when I say legendary, Druckenmiller had absurdly high returns for 3 decades. He's one of, if not the greatest investor of all time. He made a point sometime in the last few years that when the dollar is stronger, interest rates are higher, and oil is higher, when all three of those things, the dollar, interest rates, and oil, when all three of those things happen at the same time, it portends a negative economic outlook. So let's look at where we stand on those three. Interest rates are obviously higher. The Federal Reserve is on its most aggressive tightening campaign in post-war economic history. Next, here's a 5-year graph of the dollar. The dollar is nearing 1-year highs, and look at the relentless march higher since around July of this year. And here is a graph of oil, which is also near 12-month highs. I couldn't find the interview where Druckenmiller highlighted this, so I don't know if he has a specific model where each has to be making 12-month highs or 18-month highs, but it doesn't really matter. No model will tell you with 100% accuracy what will happen, and if a model worked on an 11-month basis but not on a 13-month basis, then it's not a very robust model anyway. So let's consider why this is insightful by looking at each component individually. First, higher interest rates are an obvious headwind for the economy. Real estate is the biggest transmission mechanism between interest rates and economic activity. So when borrowing is made more expensive, it cools real estate activity, which is not to overlook the ubiquitous ways that higher interest rates reduce economic activity more broadly. Higher interest rates will reduce borrowing, leading to lower levels of inflation. Next is the US dollar, and we buy more from the world than the world buys from us. Therefore, when the dollar goes up, the prices of everything we sell to the world also go up. That's bad for the US and is a headwind for US exports, which reduces economic activity. Alternatively, when the dollar rises against other currencies, the prices of everything we buy from overseas go down. This leads to lower levels of inflation. And finally, oil prices also have a very broad effect on the economy, making travel, transport, and production all more expensive. Oil can best be considered as a tax. Consumers and businesses are doing the same activities, but now they cost more, leading to less disposable income. Many commentators point to oil and say that high oil prices will feed through to inflation, and this will require the Federal Reserve to raise interest rates even higher to slow down the economy. Now, I can't tell you that higher oil prices will not make inflation higher, but I think given where we are in the cycle, it's better to think of high oil prices as a tax, which will lead to lower disposable income, and this will tend to slow economic activity. Look at it this way. We know the Federal Reserve is trying to slow the economy. As a thought experiment, imagine if oil prices went down 90%, that would be a big boost to disposable income, and I think the Fed would be forced to raise interest rates even further in that scenario. So in a way, higher oil prices are helping the Federal Reserve to slow the economy. With regards to how sticky high oil prices will be if and when we do have a recession, that's difficult to say. Both supply and demand for oil is very inelastic which is a wonky economist way of saying that the price of oil is very volatile for small changes in either the supply or the demand of oil. So during a recession, demand will drop, and I think that will probably lead to a drop in the oil price, and that'll be a great buying opportunity, but that's for a different discussion. It's also notable that since commodities are priced in dollars, there is typically an inverse relationship between the dollar and oil prices. Here's a 15-year period just to give you graphical support for what I'm saying. And you can see that typically when the dollar is strong, the oil price is weak and vice versa. So the fact that the dollar is relatively strong and the oil price is relatively strong is worth paying attention to. This leads some to speculate that we're entering a cycle of higher oil prices. To wrap up, each of these three things, the dollar, interest rates, and oil, have a very broad effect on the economy, and the movement of all three of them all point in the same direction. For me, this is an additional perspective that confirms the other leading economic data, driving me to the conclusion that a recession is more likely than not, assuming we're not in one already. Please subscribe and pass this along to your friends who care about investing and the financial markets. Take care.